Markets are pushing into fresh new all-time highs while the underlying economy is still in question for a lot of people. A little bit messier of a story, and yet when you can sift through all the noise, I think there are some bullish sentiments here that we're going to unpack on today's show. We do have labor cracks widening a little bit. Housing remains historically unaffordable despite softer pricing. New housing data coming out. Where is the market headed in the next few months? And we have potentially a rate cut here in the very near future with Kevin Warsh coming in. We're going to break it all down in today's episode. Stay tuned. What's going on, guys? Welcome back to another episode of Money Moves. As always, I'm your host, Matty A. My co-host, Mr. Ryan Breedwell.
Hey,
how you doing, brother?
Oh, we're doing great. I hope everybody is doing good.
Well, you're getting ready to go off on a little Euro trip, so of course you got to be doing good.
I'm a little. I was gonna say I miss you guys next week, but I'll be back the following. Only gone for a couple weeks here, but yeah, market's doing really good.
Well, let's unpack that because
Yeah.
S&P 500 just this morning hit a new all-time high, breaking above the 7,400 mark, and this is after closing 6 consecutive weeks in the green. Stocks opened again this week in the green. Meanwhile, oil prices seem to still be chopping around, going up, pulling back. No U.S.-Iran negotiation is finalized quite yet. Actually, over the course of the weekend, Trump called Iran's peace counteroffer totally unacceptable on Sunday, which it looked like it maybe hurt futures a little bit, and yet that didn't show any signs, and the market opened today. This idea of the Strait of Hormuz being opened, which seems to be a choke point for 20% of the global oil, the markets continue to seem to shrug it off. And anybody that's staying invested in the market is benefiting handsomely from it. It's been pretty fun if you're an investor looking at your portfolio over the last 6 weeks, just seeing it continue to shrug off all of these somewhat bearish headlines. So what, we've got a busy week here. We'll talk about what is, potentially some catalysts for a market pullback or a market surge. But, what are you guys seeing with, this very healthy bullish run that we've experienced over the last 6 weeks?
Kind of exactly what you're seeing. We've seen a lot of good movement to the upside. It looks like it's broad, so it's not just concentrated in the Mag 7. We're seeing participation from multiple areas. Today, with that mention of that hantavirus, we have healthcare and vaccine makers moving a little more, so they're participating in healthcare a little more than normal, but just a good broad market rally. And I think that it's a taste of, it's like the first half of what's to come once we get a full and finalized agreement with Iran. And then people are going to shift focus to earnings, which have been phenomenal. Again, under the Trump administration's policy, it's just been really good for corporations. They've been very profitable. We're seeing that with not only good EPS and revenue beats, but also really good guidance, because guidance is starting to be more important than, yes, you did good in the current. We know that. What do you think is going to happen in the future? So when companies are giving strong guidance, that also shows strength and confidence in the current administration's policy and in the market. And that flows through to the consumer. So I'm seeing just a lot of that. Clients are been very happy. Investment returns have been really good. We've had a great year so far. S&P's up year to date somewhere around the 7.5, 7.8% range. Lots of people have benefited from doing what you just said, not trying to time the market, being in the market, being broadly diversified through multiple areas and quality. And yeah, it's a great time to be an investor. I can say that. It's never really a bad time if you ask me. That's why I'm the permable. But it's a specific, like what you were saying, it's nice to finally reap what you're sowing. Hey, I've been buying all these assets. Market's been choppy. Got about a month and a half of some of the best market returns I've seen in years, and quite literally one of the best, if not the best, April on record in the last decade. So it's been a really good time to be an investor, and people are being rewarded by staying calm, following plans, not following the crowd type thing.
So we've got, some catalysts this week that could push the market up, that could maybe, lead to a little bit of a pullback. As of this morning, we got April existing home sales data that was released, which actually was somewhat of a beat.
Yeah.
We
asked.
Yes, right. Obviously there's still some challenges in the housing market. I think I saw U.S. home sellers now outnumbered buyers by 630,000, which I think the previous report on that was like a little north of 600. So that's continued to increase, which is still the largest gap ever. We've got April CPI inflation data coming out tomorrow. We've got PPI inflation data coming out Wednesday. We've got April retail sales data on Thursday. We've got Kevin Warsh becoming the new Fed chair this week. I think Wednesday let's see. I know that at least when it comes to Warsh, Jerome Powell is expected to step down as the Fed chair, I believe, by May 15th. His Senate confirmation vote is, maybe it's later this week. But obviously, there's, I think, a 95%, probability from a lot of the prediction markets right now that are saying he's coming in, he's good to go. And Warsh promised, in his Senate hearing, regime change at the Fed, which, overall I think is maybe bullish for advancing Trump's agenda. But, historically, like we talked about on the last show, he's been somewhat of a hawk on inflation. And, Wall Street's assumption that maybe he'll, I don't know, I wouldn't say rush to cut rates, but that he is more likely to cut rates still seems to be on the table. Now, we've seen, consumer sentiment hit an all-time low in May of this year, which was the worst reading in the 74-year history of the survey. Which was breaking the previous high in our previous record set in April. We've still got, gas averages up nationally. We've got, tariff refunds now starting to potentially happen. We've got this Iran conflict still there. So how is the market absorbing all of this and still pushing through a lot of this noise? And is there a pullback coming, or, do you see that this AI run and narrative is just really outweighing and overshadowing all of the other concerns? And is that a concern?
Well, I think that once, and I'm just going off of what has happened historically, so probably a good indicator of what will happen. On the heels of such a strong run, too, we have to kind of have these little pullbacks every once in a while. I think we might be due for a very short period of volatility, maybe a couple days, maybe half of a trading week of some retracement, some profit taking. Especially once people get a better footing on what the current Fed chair is going to do, which, again, data is slowly aligning with what I'm saying. Not really on the heavy side, but on the, if you were putting it on a number on the roulette table, July looks like the best bet so far. I still think he's going to cut in July. I don't think it's going to be an aggressive cut. I don't. I think what he'll what he'll do is he'll indicate, or hey, 0.25% cut, which we know is not a huge deal.
Right.
A couple of those. It's almost like shooting a fucking bear with a 22, right? Like, yeah, you shot it, but probably not going to kill it. So I think we'll get, hey, we're going to cut in July. We're going to see how the market digests, because we don't think 0.25% down or up in either direction is going to be a huge deal, but we think the consumer could use some sort of relief. So that's where they're going to feel it the most. It's going to be in cost of capital. We're going to give a quarter, and I think that's enough to give a lot of positive sentiment to the market, but still, in reality, in the big players now, really not that much. But if that can convince the consumer that more rates could come, the market's still up. If you keep lending money out, we're trending in that direction. That is where I think we have the most potential to happen. I don't think it's going to come in and say, hey, we're going down by 1%. I just don't see that. And if you did any research, not you, but us as the listeners, he's traditionally more center hawkish versus center dovish. And so he's probably had some very straightforward conversations with the Trump administration saying, hey, I'm not going to be your 1% cut guy. But I do think that he also is in agreement and probably has a head on his shoulders like mine. Yeah, I get that what the data says. I get that. I 100% get that. But it's kind of like parking my car in the driveway on a 75 degree sunny day. It says 107. Just because something says it is doesn't mean it isn't, but doesn't mean it is as well. It's probably 107 on my car, but it's not 107 degrees outside. I think we're having that relationship here. I think because of how we calculate the data, it's showing a scenario that people are still scratching their head on, because it's like, okay, well, if that's happening, how is core 1% lower than headline? Why are we acting like headline is core? And why is money so damn expensive then? If we're at 2.7 on core, we're sub 3 on the one you guys say is the important one. Why? And to me, it's just interest rates are stuck high. You have to moderate the cost of capital to banks so that they can still make money and charge people a lower rate. I mean, it's all it is. If you don't understand how money is made, it all comes from the Treasury, the Federal Reserve. Banks pay overnight rates to each other. That's affected by the Fed funds rate. It's called the Fed funds overnight rate. You have all these things that trigger off of this one point. And so it affects cost of capital to so many areas. And you look at hard money, for example. Hard money's on a sunny day, 13 to 14%, and I'm hearing people getting 17, 18%. And it used to be a bit. Those 17, 18s used to be 12, 13s, right? That was the high. It makes high risk deals not pencil anymore. They could pencil at 12 or 13 because you can still pull. You can't. All the meat's off the bone at that point. So you just that 0.25% could bring 10% of the deals that are on the sideline back on the table. And then once those get cooking and people get some more capital, that'll bring some other ones off the sideline. And then you'll get some banks that say, hey, we're making some money in this vein. Maybe we could take a little bit, maybe we can stave out a little tranche and take a little more risk with this money and be a little bit more aggressive on our rate. Hey, they're doing 16, let's do 4. That's what has to happen. But we have been stuck in the real estate. This is the longest bear. I don't want to call it. It's very similar to what was happening in the stock market from 22 till 23. Like, it wasn't that bad, but it certainly wasn't good.
Mm-hmm.
And it was just slowly, it's like a paper cut death.
Yeah.
And the difference and why it's not bad on the retail side, at least in my opinion, is because the amount of equity people out in their homes, and people aren't going upside down on their mortgages. Yeah, they're going upside down on their car loans. Boo hoo! That is not a back. Car loans are not a backbone of the U.S. economy. Mortgages are.
Yeah.
So people are paying their mortgages. I know there's always going to be delinquencies and people making mistakes, and people always talk about, oh, credit's going higher. Well, yeah, shit's more expensive. I mean, like, it just is.
Yeah.
Like double the cost to go to the grocery store over 5 years. So we should have double the amount of the credit we had on groceries back then. So, things are going to move a lot quicker. I think that the consumer is strong. The economy is strong. People are kind of still stuck in this era of rates being, first it was groceries. Now it's just cost of capital. We have one last thing that's like this big hurdle. Because it's just like running a car, a steam engine versus a gasoline engine, and we're running on steam right now. We're moving, but we just don't have we need the one last thing to really kick into overdrive. And historically, if you go back, look at all the really strong stock market rallies, the real estate market is participating in lockstep. I mean, both are doing well. Yeah, if people making money in the market, sometimes selling and repositioning money in the real estate, vice versa. Cost of capital is low because banks are making money. That's the environment we need to get to. We only have one half of the story right now.
Yeah. Yeah. I mean, it's saw the gap between S&P 500 and consumer sentiment is the widest in 25 years, which is interesting, right? Because it kind of shows that, I guess, what is your take from that? My take is that retail sentiment is lower or is maybe more bearish, and institutional sentiment, the smart money, is overly bullish, and they're really the ones driving this, continuous growth on the S&P 500. Is that somewhat of what you're reading in between those tea leaves, or what would you take from that headline?
Anytime consumer sentiment is so low or it's bad,
Mm-hmm.
I would typically feel bullish moving forward. It's when you have the people that don't know what they're doing drunk at the wheel and just buying everything, and they're just not doing that right now.
Yeah. Well,
Advisors are. I mean, I'm loving it. It's great to be a professional trader and allocator. It's not bad at all. I get why people don't do it. It's hard, but when you kind of know how to move through it, it's like, just like I wouldn't want to do one of your deals. Like I would be like, oh shit, what am I doing? How is this working? You'd be like, oh, let me navigate this.
yeah.
That's the same thing it's the same thing how I navigate the markets. They're just, if it's scary to retail consumers, it's probably an easier time to trade because there's less short squeezes going on. There's less dumb money flowing around. Things work the way they're supposed to work. You don't got people calling me asking, what are we putting? Have you heard about XYZ? That's when we got volatility around the corner. I'm like, oh, okay. That dumb people are talking smart. That's when we have a problem. So
even
that's where when it's this bad, it's data would show you too. I always forget if it's Morgan Stanley or Goldman Sachs. One of the two did a study on what the market actually did and what consumer sentiment was, and they ran them live. And I'm not kidding you. The second consumer sentiment goes down, the market goes up, and consumer sentiment goes up, and then you see a dip. It's that go to a casino. That's the same thing happening in a longer, drawn out way, in a more regulated tone. The house is smart money winning. They lose sometimes, but they keep pounding forward. And then you have dumb money and they're running their money up instead of taking their profits in the casino term, losing it all, and then losing all they're probably selling. And then the institution picks it up at a dirt cheap price, holds it, and runs the market back up. So that's what's probably going to happen at some point again. But I don't see that happening anytime in the near future. We have a whole, we haven't even had a real estate recovery rally. I don't even think people have. I haven't heard one person even mention that. Like, oh yeah, and by the way, when cost of capital goes down and when people start selling, there's realtors and real estate investors that put money in the stock market. They're not doing that right now.
Yeah. Yeah.
You know what I mean? So it's a big. There's all these really good things that haven't even happened yet.
Yeah. Well, Trump even said in his presser yesterday, you better start buying stocks now. This country is going to take off like a rocket straight up. He's going out to meet with Xi Jinping of China. I believe it's this Friday. He's taking Tim Cook from Apple with him. He's taking Elon Musk. I think it was yeah, he's taken multiple big CEOs and business leaders, really trying to, I think, get some more deals done. Which, knowing Trump and the businessman that he is, he's going to continue to drive investment. He's going to continue to drive partnerships. I'm very curious to see if and how the narrative around our tensions, or really maybe easing of those tensions, and some of the collaborativeness that could come out of some of these opportunities, plays out going forward, and how that could be another, bullish catalyst for the markets and just overall.
I would expect him to go and get. I would expect him to get some friendly pressure from Xi that we'd like it if you
tone down on
yeah, that's where we get our oil, dog. Yeah, 50% of it. That's where we get our oil from, dude. You're making it. We're having to buy from Russia, lower quality oil. We don't want to buy from Russia. Can we please can you chill?
Yeah,
because it's affecting China and Japan, India, Russia, kind of the most. So I would expect Xi to apply some friendly pressure. Say, hey, we'll come to the table here. Can you? And so there, a betting person might say, oh, next week we might get some rhetoric over the weekend after this meeting of Iran talks proceeding and more cooling off there.
Yep, absolutely. Now, where do you, see earnings kind of wrapping up? I know there's still a couple more. Is there anything on earnings that you think is playing a role in any of this? Any companies that you're paying attention to? I mean, I saw that freaking Intel, Macron, like they're just continuing to rip. I don't know if you saw the company that was it SanDisk or SunDisk, that if you would have invested 25K into them a year ago, it would have been worth like 2.5 million. I believe that's another AI kind of driven company. So it just seems like AI, tech, these partnerships just continue to be the driver of this narrative. And I don't know, is there any steam being lost or gained, going forward from your perspective?
I don't see. I think all of the movement is justified in both directions. I think the volatility that we had made sense. I think the market moving up makes sense. I would be more concerned if we had bad earnings and the market was moving up, because really at the nuts and bolts of why the market's supposed to go up, it's earnings, right? It's not supposed to be sentiment based only. It's supposed to be, hey, companies are making money and this is going good and there's no geopolitical risk. So if we didn't have as good of earnings as we have been having and the market was moving like it was, I would say that's unhealthy and likely maybe some sort of, not a melt up, but that type of scenario, movement upwards, it's not justified by an underlying event. That's not happening right now. Quite the opposite. We have earnings that would be supportive of that, and then we have easings of geopolitical risks. And that makes sense. I think the thing that people can't factor in yet is when the real estate market calms down, because I don't know how much of it is going to calm down. I don't know. We'd hope commercial would move with single family. I think single family is the obvious going to be where the most pressure is released from. But if we can get a commercial release too, that's going to be huge for banks. If the federal government will step in and subsidize the debt, which is what I think they'll do, because I could see Trump saying like, "Oh yeah, we'll take ownership in it until it's paid off," and then they make the government get a payment off of it or something. It's just like he's done with it. I can just see that happening. I can see how that he likes that sound. So there's all sorts of cool stuff to happen. AI is going to be the main catalyst. Trying to think, there was one other. Oh, and then I don't know if you saw this weekend. Russia's like, "Yo, we're kind of done in Ukraine."
Yeah,
As well.
yeah, I did see that.
It's been like people kind of just said, "All right, fuck it. Whenever that's done, that's done."
Yep.
That's going to be very positive. Because
Yeah, I think they're starting a 3-day ceasefire or something later this week. What is your take? I mean, I think I know what your take is, but people love to just anything that can be a headline is going to be a headline. Michael Burry has a $1 billion short on the AI bubble, 912 million against Palantir. Come on, man, he's trying to fade my stock. And 187 million.
We both fucked up on that one.
Yeah, 187 million against Nvidia. Obviously this is the same guy that shorted the housing market in 2007, 2008, while Wall Street called him crazy. And he's saying he sees the same signs in this AI bubble. What are your thoughts? Is this time different? And do you guys even pay any attention to, big investors like this, kind of putting their money where their mouth is and staking their sentiment around where they think things are headed next?
No, I just don't think there's any like fraud per se in the AI. Well, how would I say this? I don't think it's at the level. There's for sure fraud somewhere. I don't know what level it's at, but it's probably not even close to where it was. I mean, people always say like 2008, like it was just like a normal thing. It was fraudulent bank loans. They're not, they would be illegal today. You can't do those types of loans anymore. They're not allowed. So if you over leverage anyone to their nose hairs and then you allow them to keep doing it, yeah, eventually that's gonna hit. That's we see that with low income earners and credit cards, right? But that's just not happening. And AI actually has like it's a real product. It's really being applied in multiple spaces. Huge established companies are putting real capital behind it. And we're not talking about, hundreds of millions. We're talking hundreds of billions. The US government is putting money into it, or putting money into helping the development of AI chip development. So I just think it's different. I don't want to say different this time and be cliche, but I do think it's different this time because it's a completely different category of asset, first of all. It's not something that somebody can just go out and say, make it, right? It's a very high intensity, high throughput product. And it's just not a bank loan. It's just not. I mean, if AI fails, yeah, the companies that are in AI will go down, but the money's not going to disappear. It's just going to go somewhere else. And then we'll just follow that. We'll just chase that where that's going to. So it's just, no, I don't see that being a thing. Again, I get why people, very typically not very smart people, are bearish because they don't know how to be bullish and be correct. And so they grasp onto easy to hold straws like, oh, I've been saying things are going to go down, and what's the next thing that could be in that vein? Yeah, totally. And you know what? I'll even say this. There's going to be AI companies that fail, that go bankrupt, and that people put their money into and lose. Same with solar, same with banks, same with real estate, same with anything, because welcome to capitalism. That's how it works. But to ascertain that that's going to then lead to to a like downfall of the US economy, that's where you start sounding like you don't know what you're talking about, because it doesn't have that type of thing. We don't issue loans based off of AI. We don't do mortgage-backed security. We don't do AI-backed security. So, I would just tell those people, educate yourself or hire a financial advisor, because you don't know what you're talking about.
Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position, asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. Well, I think to your point, I mean, again, I try and follow the smart money and the big, institutional investment firms that have seemed to be way more right than they are wrong, right? Blackstone CEO Steve Schwartzman, who one of my favorite books of all time from him actually, he declared that Blackstone, his firm, became the largest investor in AI-related infrastructure in the world, owning 150 billion of data centers globally, while simultaneously filing for a new data center REIT IPO targeting 1.75 billion and working on a potential $35 billion financing deal with Broadcom. Blackstone reported 1.8 billion in net profit in Q1 2026, with 1.3 trillion in total assets under management. So when you see big, companies like that, staking, putting their money where they believe the future of things are going, it's hard to fade that, right? I mean, you're betting against the juggernauts and the Goliaths of the industry that, I look at someone like, Michael Burry is kind of the David, but he just really has no shot at competing with these types of, organizations. So I just think, I mean, even you see JLL forecasts nearly 100 gigawatts of new data centers are going to come online between 2026 and 2030, equating to 1.2 trillion in real estate asset value creation and 870 billion in new debt financing. Like, these are real catalysts that are showing where the future of investment, where the future of tech, where the future of AI is headed. And it still feels very early in that process, not late and overly inflated in that process, in my opinion. So I don't know. I mean, it's just one of those things where it's really hard to think that we're, with the narrative of AI still being very fresh and green for a lot of people, that we're late in this cycle.
Agreed. It's kind of like it's the never-ending argument about whatever is moving the ball forward currently by those who were successful moving it prior. And they just don't want change. They're not positioned for change. And there's, sayings for that. Nothing changes if nothing changes. We'll be talking about much different things 5 years from now than we are today. And so that's something to be cognizant of and aware of, and just know that that's how the world works. And it's, especially with technology, faster and faster and faster and faster and faster. And the more that happens, the more that people understand how to invest, the faster that data moves. I would say the less volatility and the more short-lived that we'll see these downward volatilities, and the more upside that we'll see, at least in the stock market, because people want the market to go up, not down.
Yep. Yep. Absolutely. Now, single family housing market, still continues to remain relatively stale. We did see existing home sales, 4.02 million today. While we do have a significant amount of home sellers outnumbering home buyers, like I mentioned earlier in the show, 630,000, which is the largest gap ever, home sales still somewhat are holding steady and strong in many ways as well, which is somewhat perplexing, to a lot of people. But I think it was National Association of Realtors. Let me see if I can pull this up. For the first time since the pandemic era, more homeowners now hold mortgage rates above 6% than are locked into sub 3% rates, ending one of the most powerful supply constrained dynamics the housing market had ever seen. So NAR projects a 10.7% jump in existing home sales in May alone, the biggest seasonal surge in years, as the housing market returns to pre-pandemic norms, with homes spending just 30 days on market. More inventory means more deals, more motivated sellers, and more opportunity for investors to know how to move. So interesting there. Now shifting over to the multifamily and commercial real estate sector, national apartment vacancy just hit its highest level since the financial crisis. But here's why that's actually bullish for smart investors, in my opinion. Now, the national apartment vacancy rate has risen to 8.6%, which is the highest since the post-financial crisis recovery period, after 1.8 million new units were delivered over the past 3 years, the largest supply wave since the 1980s. But multifamily starts are now falling sharply. CBRE released a report that noted 105% monthly premium to buy versus rent, meaning basically that structural demand stays strong even as this near-term supply pressure is somewhat peaking. So the investors who buy into oversupply cycles and hold through the absorption window generally outperform and win. Now, we do have a very significant amount of debt maturing this year in 2026. Specifically, I think it's close to, I'll come back to that number, but very significant amount, billions, maturing in Q3 and Q4 of this year. And, I don't see overwhelming amounts of distress. I think it's just more so of the market flushing through some of these. It's more of a calendar, right? And so these are, the things that you just kind of have to pay attention to, of like, based in the commercial real estate debt cycles, there's, an oversupply of debt maturing in certain quarters, and there is an debt restricted supply of debt maturing in certain quarters. This just happens to be one of those. So I'm actually really interested to see, with some of these catalysts that we've been talking about for some time, like, how does the market absorb this?
Yeah.
And how does this all align with what Warsh and the Fed do with interest rates? How does this align with where things are at with the conflict in the Middle East, or where the economy is at and the stock market is at? So it's going to be interesting. But again, I just think there's a lot of great opportunities in the market right now. As you always say, there's always a bull market somewhere. And I do think that there's some good opportunities in the commercial real estate space as well. Now, as we wrap up, Bitcoin sits at 81. Let me see. Let me check it real fast. I think it was this morning. It was 81.2. It's 81, almost 7 right now. Approximately 22,900 lower than 1 year ago, representing, let's call it, a 20% year-over-year decline. And while retail sentiment sits in somewhat of that fear territory, it seems like Bitcoin is, following a little bit of this multi-week rally that the stock market has. Do you see it decoupling at any point and having that pullback, or do you think it's going to continue to run and climb right alongside, and we've actually seen the bottom at the 60K or whatever it was that we saw, when the Iran war broke out in late March?
I think that we're getting to the point where the market's going to choose who the crypto leader is, and this is the closest on volume I've ever seen Bitcoin and Ethereum trade in up market. So I think the Bitcoin volume is somewhere around 32 million, and Ethereum is sitting around 25 million right now. So it typically was like 30 to 7 million, 30 to 10 million. So the volume has doubled in Ethereum while it stayed about the same in Bitcoin over the last about year. So,
And that's from what I was seeing, a lot of that being driven by multi-week ETF inflows of more. It seems like more institutional capital is now getting a tiny bit more exposure to the crypto markets. The narrative's getting a little bit louder. This week, I believe they have the Clarity Act markup where that, if and when that, kind of gets finalized and hits, I think that's going to open up, the floodgates to more capital and interest coming into the crypto market. So I am optimistically, bullish like you, where I think, of course, bullish macro long term. I think crypto is at the early stages still and is going to continue to, attract more capital and more interest. And as they work out more regulation and they make the tech, more user friendly and easy and comfortable for people to get in on the space, it's going to win long term. Short term, I'm not sure. I have no idea. I know you mentioned that you still think there could be a pullback into the low to mid 40s or 50s for Bitcoin. So you're thinking that we haven't necessarily found the bottom yet in this bear cycle?
no, I don't know if we're in a bear cycle though. I just think that Ethereum is going to flip Bitcoin on market cap size and volume eventually, and then that will take Bitcoin down, because the only thing that keeps Bitcoin up is that it's the one most referenced, it's the most familiar. But once Ethereum takes that from Bitcoin, I think that people are going to quickly move their money into Ethereum. I just think they will, or things like Ethereum, Solana, Ripple, uh, things like it. Just not Bitcoin.
Yeah.
Bitcoin. Nobody's building any projects on Bitcoin, like, at all.
Yeah.
I don't know if you know, whenever people announce stuff now, it's like Solana, ETF, Ethereum ETF. It's not Bitcoin.
Yeah.
Bitcoin started it. All got a pair of dues, but it took a while. But that's why I'm long, baby. I told you guys.
Well, let's get on.
And a lot of people don't like. I wouldn't do. I would be putting my money in Ethereum if I was a crypto investor, but I'm not.
Well, we're going to wrap up on that. We're going to get you off on your Euro trip, brother. I hope you have a safe flight. As always, we appreciate you guys tuning in each and every week. If you have questions, comments, shoot us a text, 844-447-1555. If you want to connect with Ryan and his amazing team, you can always do so by texting the word X-ray to get a free financial portfolio review. They do a full financial X-ray on your existing portfolio, free of charge for all Millionaire Mindcast listeners. So text the word X-ray to 844-447-1555. The income fund, being a hard money lender and bank alongside me, is officially open. So we have fortunately loved connecting with many of you who have reached out. If you are interested in learning more about that, just text the word income to 844-447-1555 if you want to learn more about getting some true mailbox money and lending on collateralized assets. Very boring, income fund. No sexy pro formas and syndication models. This is just putting debt in first position on safe collateralized assets. So as always, thank you guys so much for tuning in. We will catch you guys in next week's episode. Until then, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Cheers.